Have you ever been told that your credit isn't good enough for a VA loan? If you're a veteran, that might be bad advice. I'm Jason Wood, and after helping thousands of veterans with their home loans and lending for over 2 decades, I'm here to share with you the ins and outs of credit score requirements for VA loans. The VA loan happens to be the most flexible loan program there is when it comes to credit requirements. So today we're going to tackle one of the biggest misconceptions about VA loans, which are credit score requirements. If you've been told that your credit isn't good enough, stick around. This might be the best news that you've heard all year. Today in our video, we're going to talk about the following items: VA versus lender guidelines, what the VA actually looks for, what lenders are actually looking for, credit improvement tips, how to find the right VA lender, and special credit circumstances. Here's something that might surprise you, but the VA actually has no minimum credit score requirement. That's right, I'll say it again. The Department of Veteran Affairs for the VA loan program has no minimum credit score requirement. So why do you keep hearing about credit score requirements? Well, the lenders are the ones who establish the credit score requirements for themselves. So every lender is essentially creating their own version of the VA loan simply by placing a minimum credit score requirement on there. And the VA totally allows this because the lenders are the ones who are actually lending the money. The VA's role in all of this is just to guarantee the loan. So as long as the VA's minimum requirements are met, they're okay with the lender adding what's called an overlay to the VA guideline and establishing maybe a credit score minimum. Most lenders look for credit scores between a 580 or 620 credit score as the minimum. There are some banks, big name banks out there who will require a higher minimum credit score, to 640 or even a 660 minimum credit score. Now, either way, the VA loan is still more flexible than its counterparts like a conventional loan, which oftentimes require an even higher credit score requirement to qualify. The VA loan is still quite a bit more flexible. The important thing to remember is this requirement varies from lender to lender. And I can give you a very specific example. I had a client come to me one time who was told no. They went to their bank where they do all their banking and their direct deposits go to. It's one of the big banks we all know of. They went there, applied for the VA loan, and they got told no, they were declined because their credit score didn't meet the minimum that bank had set for the minimum credit score requirements. When we worked with them, their credit score was great as far as what the VA requires, and that's no minimum. And we were able to help them and got them into a home when the big bank told them no. But the important thing to remember is every lending company and every bank may vary slightly in what they require, or maybe greatly depending on who it is. So it's important to ask those questions, especially if you're concerned about what your credit score is. That doesn't mean you can't get a VA loan. It just means you may need to look for a different lender. In my 20 years of specializing in VA loans, I've noticed that a lot of lenders require a 620 credit score or higher in order to get the VA loan. A lot of them will go down to a 580. Some will go even as low as a 500. We're capable of going to a 500, and we're also capable of helping somebody with no credit score. We had a situation like that a couple years ago where we had just a super financially responsible person who just didn't use credit, was a great saver, never used credit. So when we pulled the credit score, or the credit report, it was blank. There was no credit score, just their name and their information, and that was it. The VA is one of the few loan programs out there that will allow you to get a mortgage with no credit score. But if you do have a credit score, it's got to be at least a 500. So if you're in the 400s and you've had some turmoil on your credit, then we'll talk about some things and some tips to help you get that up. But you're going to need to get it up at least into the 500s. So let's talk about what the VA actually looks for when they're reviewing your file. So the VA doesn't actually specify a specific credit score. So what they're looking for, what their requirement is, because they're not actually reviewing your loan file as we're working on it on the lending side. They may audit it later, but they're not actively working on it with us. So what they're looking for is your credit worthiness. So they want to see just how you treat debt. They're not as concerned about the score itself. What they're concerned with is how do you treat debt? All of us have had life happen to us. Sometimes it's an accident. Sometimes it's a health thing. Sometimes it's a job loss. Sometimes there's things that are outside of our control that have an impact on our finances, which can then bleed into our credit scores and making payments. Life happens sometimes and we can't control that stuff. The VA is very sensitive to that as long as it was something that was outside of your control. So they are actually just concerned with credit worthiness. How do you treat debt when it's offered to you and extended to you? How do you treat that debt? Do you manage it responsibly? And if there were some bad marks on your credit, what was the reason behind that? Like I said, if it's something that was really out of your control, the VA is very forgiving about it. What they do not like to lend on is people who are just irresponsible with it. getting credit authorized to them and then just not paying it or not paying on time and just really treating it poorly, that's where the things can get a little bit murky. So some things that they're looking at focusing on is your payment history, obviously, which I mentioned. They want to just see, how do you treat that credit? Your history of managing similar obligations. So remember, you're applying for a mortgage. So they're looking at your credit worthiness to see, how have you treated other things that are similar, right? Have you gotten other loans, like a student loan, maybe an auto loan, maybe a personal loan or a credit card? How have you treated that stuff in the past? What's the payment history look like? Did you max it out? Did you go over the limit? Did you pay it on time? Did it get repoed? All those kinds of things are the stuff that they're looking at. And that delves into what the overall behavior of your credit profile is. How do you behave when managing your credit? And then also they're looking at significant derogatory events like a bankruptcy or foreclosure or deed in lieu of foreclosure. Things like that are pretty significant and can really drive down your credit score hard on your credit report. So they're looking at that stuff. Not that you can't get a VA loan still with those things on there, but now we're going to have to dive into the further explanation of why it happened, what was going on. So the VA puts emphasis on the past 12 to 24 months. And if there was some big event that happened outside of that 24-month period that's still reporting on your credit, they certainly are going to want to know about it. But that's the past 12 to 24 months where really the emphasis or the focus is going to be on your credit history. So for example, a veteran applying for a VA loan that has a 580 credit score, but has 12 months of on-time payments with his credit card will be looked at more favorably than somebody with a 620 credit score who's had intermittent payment history and been on time and then kind of been late a month and then back on time for a few months, then late a month. The person with the 580 score is going to be looked at more favorably in that example. Now, the VA also considers extenuating circumstance as part of its basis for determining credit worthiness. So I'll share with you some of what those examples are. Stable employment history. That's one thing that can help get the VA to overcome maybe some stuff that's challenged on your credit report. A low debt to income ratio. So if we're not maxing out what you're capable of financing, that's another benefit that the VA sees as a reason why to grant the loan. Significant savings or reserves. Now, the reality is if the credit's probably not in good shape, significant savings and significant reserves probably don't exist. However, if you have a 401k through work, or maybe you have the TSP if you're still active duty, and you've just been plugging into that, just kind of out of sight, out of mind, and it's been accumulating, that can be a really, really important factor that helps a lot of people oftentimes. I've had many files that have been approved by the VA because they just had that savings plan going. And while the credit may not have been spectacular, because they had that, it showed that there was at least some responsibility with finances and kind of a fallback plan in case they got in a sticky situation with making the mortgage. There was at least the ability to tap into some money to help them out. Excellent rent history. So there might be some things that maybe happened on credit and some circumstance that happened, but you kept making the rent payment on time and you've got a great history of paying your rent. That's going to weigh really heavily because it's a housing payment, right? And so as they're granting a loan for a mortgage to buy a house, they're comparing that a little bit. Like, okay, had some credit challenges. All right. How about the rent? Oh, rent, spot on. Okay. Well, now we can probably gather that if we give you a mortgage, you're going to be spot on with the mortgage, just like you were with the rent, even though some other stuff may have taken place. And lastly is long-term service in the military. That also can benefit you quite a bit. If you've been serving for a long time, you've been in the military, it's been 17 years, you're still in, or you're 23, you're still plugging away. Like that can weigh heavily as well to help get you in there when credit isn't supporting everything else as well as you'd like it to. So beyond the credit score, let's talk about what the lenders actually look at, because it can be a little bit different than what the VA requires. So one of the things that the lenders are looking for is payment history. And we kind of mentioned that with the VA is looking at the same thing, right? Everyone wants to see, and that's why the credit report is so important, because it's kind of a crystal ball into the future of how have you paid stuff in the past, because that's probably pretty representative of how you're going to pay things in the future. So the payment history is a really big one. Your debt to income ratio. Now, the lower that debt to income ratio is, the more favorable your approval on a loan is going to be, especially when credit is a challenge. Where people often find some friction in getting their VA loan approved is when they're really pushing the limits, right? You're pushing that debt to income ratio limit. Credit isn't looking good. We haven't been on the job a long time. We don't have any money saved, right? We're trying to get in there on the skin of our chin rather than have something substantial to lean on and go, hey, I know it's not perfect on the credit, but I've got this and that and the other thing that are going for me. That's what the lenders want to see as well. Residual income. Now, this is a unique calculation that the VA requires all of us lenders to do, and it's unique to the VA loans. Like conventional loans don't have a residual income calculation. So the VA loan does. And essentially what the VA residual income calculation is, it's an affordability test. So they have some metrics that we have to meet on the lending side to make sure you meet this. And even if things look rosy and peachy on credit, we still have to do this equation to make sure that we meet the VA's requirements. So another thing the VA doesn't require is a maximum debt to income ratio. However, they do require this VA residual income calculation be met. Essentially what this is an affordability test where we're taking in your current liabilities, the proposed mortgage payment, factoring in some money for maintenance and utilities on the house, kind of based off square footage, and then comparing that against your family size and the region of the country that you're looking to purchase in. And the VA wants to see, depending on the region and the family size, they want to see a certain amount of money left over after paying all your bills, which makes sense, right? No one wants to be mortgage poor where you just got a mortgage and now you can't afford to go to the grocery store, or you can't afford to go out to the movies once in a while and have some fun. They want to make sure that you can still have life beyond the mortgage payment. So that's why they have us do this residual income test. And it's really, really a valuable thing. And one thing that the lenders have to key on, regardless of how great or not great the credit might look. Stable income is another thing that lenders really look at. So like I mentioned with what the VA looks for, the lenders are looking for something similar, is that stability, right? Where is the rock that we can kind of lean on to get your file through? And if it's not, we got money saved in that TSP account, is it we've been on the job a long time. We've been plugging away. We've been consistent. We've been working at this company for several years. And there's something that we can base on there, which is a benefit. Like, hey, look, some stuff may have happened on the credit, but they're dependable, right? They show up to work all the time. They're making good money. They're consistent with it. The paychecks are consistent. It's not like they're 40 hours and 10 hours and 12 hours and then 40 again. It's like it's very consistent and stable. That's something that the lenders really look at as well. And lastly, recent major derogatory events. So a major derogatory event would be like a bankruptcy, a foreclosure, maybe even a car repossession. So those are things that are major credit situations that the lender's going to look at, and they're really going to weigh heavily on the decision. And really what's going to weigh the most heavily is the reason behind it, right? Like I mentioned before, if there are life circumstances that came up that then pushed you into a situation that was out of your control with finances and stuff, that's looked at much differently than someone who just decided not to pay or got frustrated with a creditor and decided, I don't like you, we got an argument and I'm not going to pay you. And then it trashed your credit, whether it's, on a mortgage or an auto loan or something like that. That's what they're going to be looking for is, was there an irresponsible behavior that caused it? Or was it something that was out of your control that caused it? And depending on what the situation is, that will weigh very heavily in your decision-making if there's a major credit event. One thing that's an interesting difference, which I touched on a little bit here, is the difference between VA loans and other loan types, like a conventional loan, for example. All other mortgage programs are very strict and very sensitive to the debt to income ratio, where the VA doesn't have a debt to income ratio standard. They focus on the residual income. So it's more of an affordability test. So that's a really stark difference. So, with people in really stellar shape, with money in the bank, solid income, great credit, man, that debt ratio can be stretched way, way, way further than some of the other loan products that are out there on the market. So it just goes to show like how flexible and malleable this VA loan is. And it's a really powerful purchasing tool, especially compared to the other products. All right, let me give you some credit improvement tips, because this is going to be important. If you're watching this video, you're probably like, okay, great. I'm not that guy with the 800 credit score and 100 grand in the bank. That's not me. What can I do to get myself in a position where I can buy the house, fix up the credit enough where I can get this VA loan? So one of the first things that we'll advise people to do is let's look at the credit cards. Credit cards have a lot of sway and they have a lot of influence on your credit score. So we all know, first off, payment history, pay them on time. That's an important one. So let's be on time with it. But the other thing, which is really critical and helps your credit scores or can hurt your credit scores, is how much your balance is compared to your limit. So the ideal balance to have for your credit scores to go up is to have a balance of 30% or less of your limit. So let's just take, for example, you have a credit card with $1,000 limit on it. If your balance is $333 or less as a carrying balance, then that's going to be positive for your credit scores. And over time and timely payments, that will help your scores to improve. When you get above that 30% threshold to about 50%, you really just I call it like treading water. Your score's not really going up, but it's not really going down. It's just staying static. But when we start creeping over 50%, when your balance is over 50% and creeping up closer and closer to your limit, the closer you get to that limit, the more your score starts to decrease and go down. And oftentimes we'll see, if the scores are really in bad shape, a lot of times what we'll see is credit cards at or sometimes above the limit, right? And so that's where if you get above the limit, that can really drag your scores down fast and heavily. So first thing we want to look at is that balance. Get it 30% of the limit. And you might have some big credit cards where that dollar amount is just not obtainable for you at the moment, but you might have a couple others that are small. So what we'll do is we'll look at those smaller ones and say, okay, what's feasible in this range of time to meet your housing goals? You're not going to buy a house for a year? Great. In a year, can we tackle some of these small ones and get those down to 30%? Because those will have an effect on your credit score. And that's the goal, right? Is to get that score to move up. The next tip is don't apply for new credit, right? If you're trying to get a mortgage and this is really the goal, then don't start applying for other types of financing, because every time you apply for a different type of financing, it's dinging your credit score. And even on your mortgage credit pull, it's going to ding your credit score a couple of points. Now, there are some misconceptions about how much it dings your credit score. A lot of people have a fear that it's hitting their credit score for 20, 30, 40 points. That's not the case. That's not true. But anytime you do an inquiry, you're looking at anywhere from like 2 to 3 points on average is what it's going to take your score down to. So if you're applying for a mortgage and then you apply for a personal line of credit and then you apply for an auto loan and then you apply for a credit card, all of those applications or those inquiries are going to bring your score down each time. So we want to be sensitive to that. If the goal is to buy a house, then we don't want to take out any other new debt. We don't want to apply for anything. 1, for the credit scores, 2, for the amount of debt and the payment, because that's going to affect how much home that you can afford. Disputing errors on your credit report. So we want to make sure that we're clear on this. So you can pull your credit report for free once a year from the credit bureaus. And what you want to do with that is look for things that are incorrect, right? And anything that is incorrect on there, you can dispute the correctness of that, right? Like, hey, you have this address history wrong or date of birth or whatever's on there, or hey, I've never had a credit card with such and such company. Those are the types of things that you want to dispute to get that stuff cleaned up, because you want your report to look accurate. So it's a good thing to do, a good practice to do is once a year, just take a look at your credit, make sure that it's correct. When we talk about disputes, though, there's another dispute that can hurt your credit. So disputing just factual information that may be incorrect, totally fine. When we're disputing a debt, that's where we can get into some challenges with score. So I know oftentimes we'll get a credit card company or something like that frustrates us beyond belief, and we get all hot and bothered with it, and we're like, that's wrong, they're wrong, I'm right, and you might be. But when you go and file a dispute with the credit bureaus and say, I am in dispute with that charge or that late or that amount, that balance or whatever, then what happens is they mark on your credit on that line item that it is a disputed item. That is a negative for your credit scores. So we don't want to get into the boxing match with the creditor saying that I'm right, you're wrong, I'm calling the bureaus and I'm disputing it, because you lose in those boxing matches. So it just tanks your score. So that's not the objective. That's not the way to handle it. And if you get in a situation, we can help kind of coach you through how to deal with creditors on stuff like that. But you definitely don't want to just call the bureaus and be like, I'm in dispute with that Visa card, they're wrong, I'm right, because that's going to tank your scores. Another tip is just make sure that you made all your payments for the last 12 months on time. Even if your balances are high and it's above that 30% mark, at least just being on time, that's going to help. I mean, that's step 1. Like, make sure that we're making our payments on time. That's really, really important. And lastly, consider a rapid rescore. So this is something that your mortgage professional, we can help you with. So let's say that we've taken a look at your credit. We've determined that we need to pay down some things in order to help boost your scores. Fast forward a few months, now you've paid those things down. What we can do is get revised statements from the creditors, and we can send it into our credit companies for what we call a rapid rescore. And they can actually go directly to the credit bureaus and say, hey, look, these creditors have been paid down to such and such balance. Can you please rescore this? And they will do a rescore. It takes a couple of days, and we'll have that new credit score, which will reflect all the work that you've done and get the scores up in a really quick manner. The natural progression of you making those changes and just the bureaus reporting it naturally and getting through that scoring metric can take a couple of months. So the rapid rescore can shrink that down to a couple of days. All right, let's talk about finding the right lender, because there are so many mortgage lenders out there. It's like, how do you choose? You go online, you drive down the street, you watch TV, and there's always an advertisement thrown in front of you about some sort of lending, where there's a mortgage company on the side of a stadium, right? That's the stadium's named after. So, there's a lot of in our face about mortgage lenders. So I'm going to give you some tips on how you can choose the best mortgage provider for you. So if you're looking for a VA loan, I'll tell you, number one, you want to make sure that your lender specializes in VA loans. Now, every mortgage lender out there can click the bubble on their computer for VA or conventional or FHA or whatever the loan type is. So they can all click VA and say, yeah, I do VA loans, which technically they can do a VA loan. The difference is the average loan officer does 2, maybe 3 VA loans per year, right? So that puts them pretty out of practice. Now, not that the VA loan is uniquely complicated, but the VA loan is different than the other loans, and it requires a level of understanding of this loan in order to help you the best way possible to really extract the power that this product has to offer. It's more than just a 30-year fix with an interest rate. There's a lot of really cool benefits with the VA loan. And if you have a loan officer that doesn't understand those, it can really impact how great of a loan you could have obtained or some of the things you could have done through maybe your purchase transaction, or B, it could thwart you from even getting the loan altogether. So you want to make sure that you have that person that has experienced in it. I liken it to getting personal training, right? If you were going to go get in shape and you went to go hire a personal trainer, you've got the person at the gym who's super fit, looks like they work out all the time, it's got a bunch of clients. Then you got the other trainer who's super overweight, clearly they're not, following their own recipe. Which one do you pick? Well, if you want to get in shape, you're probably going to pick the person who's super fit, has a lot of clients, looks like they're doing the right thing, right? That's, I think, who we would all pick. No different on your lender. You want to pick the one who's doing a lot of VA transactions because they're going to know it in-depthly, inside and out. Another tip for choosing your lender, especially if you're concerned about what your credit score is ask them, what's their minimum credit score? If you're walking into your bank where you deposit your checks all the time and you're interested in getting a VA loan and you're considering going through that bank, one thing you may want to ask them is, what's the minimum credit score? Their minimum credit score might be above what you actually have, so it's easy just to eliminate them off the list of contention. Look for the reviews. Do they have good reviews? Have other people reviewed them and said positive things about them? That's going to be really important. Everything is digital these days. You can go online and you can find reviews, you can find information about people. And the other thing is, when you go online, can you even find them? Oftentimes, there's still people out there, you can't find anything about them when you search online. There's no social profiles, there's no business profiles, there's no reviews, there's no nothing, right? You want to make sure you can find something out because you're financing a home, several hundred thousands of dollars. This is a big deal. This is a big transaction. This isn't running down, to get a TV from Costco or compare the price between Costco and Target on the Black Friday sale. Like, this is a big deal. This is something that's super important. So you need to make sure that they come with some reviews, you're able to find them online. And even more importantly, do they come professionally recommended to you? Is there another professional out there who's recommended that lender to you? Maybe it's your real estate agent. Maybe it's your financial advisor. Maybe it's your tax person. The reason being, those other professionals are not going to refer you somebody who's going to do a bad job because their reputation is also on the line. So they're only going to refer people who they know and trust are going to do an outstanding job and take really, really good care of you. So those are some good filters to add as you're looking to choose who the lender should be. Another thing when choosing a lender with a VA loan is make sure they understand military pay structures. They know how to read an LES. They understand how to pull a certificate of eligibility and read what your disability income is and how to do those gross up calculations. There's a lot that goes into that stuff, and the average lender who doesn't do a lot of VA loans is not going to understand that stuff. And I've even ran across underwriters who don't do enough of it and stumble on it as well. So they got to be practiced. They got to understand those things. And are they able to educate you and explain the process clearly? One of the things that we learned from the big 2008 crisis that we had, the Great Recession and the mortgage meltdown and all that stuff, one of the things that we learned is people were not getting any level of education about their home loan when they were doing their financing. They were just signing paperwork and no one knew what was on it. And of course, there are all sorts of lawsuits and everything that came out after the fact by people claiming they were never told anything. So it's important that when you're talking with the potential lender, that you're able to get educated on the product, on the process, and you have a sense of comfort with them that they're going to do a good job for you and that they know what they're doing. Lastly, I would ask, what is it that you do as a lender that would help me to get my offer accepted? Now, the reason you want to ask this is because no two lenders probably do it the same. So how we do it here with the VA Loan Guy team is we try and help you get the offer accepted. So when you send an offer over to that seller, we're following up with a phone call, we're sending a video, we're talking to that listing agent, and we are selling them on why they need to take your offer. A lot of times that can be a realtor on the other end who's deathly afraid of VA loans. So we need to overcome some of their fears of just the loan type before they even look at your offer. And most lenders aren't even involved at this phase. They're not even copied on this email. They don't do anything. Even if they are copied, they don't pick up the phone. They don't send an email. They don't do a video. They don't do anything. They're just waiting for you to tell them it's time to go and do a loan. So you want somebody who's going to make that additional effort, right? Because getting the house is the victory, right? You want to be able to get the house that you fell in love with, that you envisioned having your family at, and the barbecues, and just having a life in this home. That's the one that you want. So the important thing is getting into that house. Your lender can play the most critical role in this. I get a lot of positive feedback from doing this, and oftentimes this is the reason that our client's offer gets accepted over somebody else's offer, is because of this effort that we're making right then. And lastly is, what is their communication protocol? When you ask this question, if they don't have a quick answer, they don't have a protocol. You want somebody who has a clear and decisive method of communicating to you during the transaction. Having worked with thousands of real estate agents, I can tell you that their biggest gripe and their biggest frustration with lenders is they don't get any communication. But once you've made your offer on a house, there's some stuff the realtor's handling with transactions, some additional repair negotiations and stuff. But ultimately, if you're getting financing, the loan is the biggest piece to the success of this transaction closing. And if they're not able to have a regular dialogue with the lender to make sure everything's okay, it can make for a really challenging and a really stressful home purchase. So we want to make sure that they have an actual protocol that they can share with you and tell you exactly how they're going to communicate and when during your transaction. All right, let's talk about special credit circumstances. There are a few special credit circumstances that both lenders and the VA are going to look at, so we need to bring those up and talk about those. Bankruptcy. Now, this is something that a lot of people are afraid of. Some people might be ashamed of, but I can tell you the VA will work with you if you have filed bankruptcy. Now, here are the rules for it. If you filed a Chapter 7 bankruptcy and it's been discharged, the VA will allow you to get a new mortgage once 2 years has passed from the discharge date. So the Chapter 7 bankruptcy is the one where you basically eliminate all the debt. It's just gone. It's wiped out. That's Chapter 7. So once you get the discharge document, which is a document that says your bankruptcy has been discharged 2 years from that date, and you can get a VA loan. In comparison to a conventional loan, you have to wait 4 years for the same thing. So Chapter 7 is 2 years with VA, 4-year wait with conventional. Now for Chapter 13, if you file a Chapter 13 bankruptcy, this is a little bit different. The Chapter 13 bankruptcy is basically a repayment of debts. So oftentimes what happens is your debts get renegotiated, payments get renegotiated by the trustee, and now you have a payment schedule. And every month you're paying the trustee, and they're delineating that to the different creditors based on the negotiated amount that they're settling for. This Chapter 13, you can actually get a new VA loan after you've had 12 on-time payments with the repayment plan set up by the bankruptcy documents. So this one can actually get you into a house a little bit faster, although you still have some of that debt you're working on, so you still have that monthly payment, but you can do it in as soon as 12 months. Foreclosure. Now the VA requires you have a 2-year wait period after foreclosure, where compared to conventional loans is 7 years. However, if you foreclosed on a VA loan, the VA may require you to pay back the entitlement, which is their guarantee. So that can be on a case-by-case basis. So if that was the situation, we can look into that circumstance for you, pull your certificate of eligibility, and make a determination in communication with the VA to see if you're in that situation or not. But typically it's a 2-year wait after foreclosure. Collections. This is another thing that can pop up on credit reports. Now the VA actually doesn't require that collections are paid off. And in fact, medical collections aren't even considered. So what they're going to be looking at with collections, however, is what are they? What are the amounts? Kind of what is the history? Were they all kind of in a condensed time period? Or is this a prolonged thing? Like 5 years ago, there was a couple collections, 4 years ago, a couple, 3 years, and like every year there's a couple of collections. Or was it an isolated event? Was it something small? Was it something massive? So understanding what that is, the VA is very forgiving when it comes to credit things and collections and stuff. So if they're small collections, it's not going to be a big deal. But if it was something big or there was a continuation of them, then it's going to have to be addressed. Another unique situation you might find yourself in, especially for an active duty member, someone who's still living on base, is you're living on base, food is paid for, uniforms are paid for, like you really don't have a need for credit oftentimes, or you maybe have a tiny amount of credit. A lot of times you can have low credit scores just because you don't have much credit or much happening. So that can just kind of be the result of being active duty and, being a younger enlisted person, and that's just how it goes. But thankfully, the VA loan is there to help you out and can be more forgiving than a lot of the other loan products out there. And in some cases, the VA will allow you to use alternative forms of payment like utility bills, rent payments, cell phone payments, things like that. If you didn't have anything on your credit or not much of a credit score, we can use those to validate your responsibility when given the opportunity to be extended credit. And a utility bill kind of is like being extended credit. They're going to give you the power, then you pay them afterwards, right? So it's very similar to how a credit card works in some respects. So today we went over what VA versus lender requirements are for credit, what the VA looks for. We talked about what the lenders look for. Gave you some improvement tips, how to improve your credit, how to find the right lender, and then also what are some of the major derogatory credit items and how do we deal with those? So in conclusion, your credit doesn't have to be perfect to get a VA loan. The VA loan is designed to help veterans get into a home. And that's why it's one of the most flexible loan programs out there, especially when it comes to credit. If you've been told that your credit isn't good enough, I can tell you after 20 years of serving veterans and doing VA loans, that persistence pays off. Don't let credit concerns keep you from exploring your VA home loan benefit. There's gonna be an opportunity for you. Get with somebody like myself to help walk you through the process. If you found this helpful, please hit the like button, share this with a friend, and subscribe so we can help more veterans get into a house.